Ever wondered about the top 3 unstoppable dividend growth ETFs to buy and hold forever? Today, we're going to explore that very topic, introducing you to 3 ETFs that have shown remarkable resilience and promise: VIG, SCHD, and VTI. We'll explore why dividend growth is such a vital cog in the wheel of long-term investments, so buckle up for an insightful journey into the world of powerful investment tools. Stay tuned as we delve into the details of these powerful investment tools. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. First on our list is the Vanguard Dividend Appreciation ETF, commonly known as VIG. As we delve into the world of exchange-traded funds, or ETFs, VIG stands out as a unique player. It's not just an ETF, it's a symbol of confidence, a beacon of financial growth. It's like a magnifying glass, focusing on companies with a solid track record of increasing their dividends over time. This isn't just about immediate returns, it's about the promise of greater rewards down the line. Picture a tree, if you will. In the early stages, it's small, unimpressive, but with time, patience, and the right nurturing, it grows. It expands, reaching higher, spreading wider. That's the kind of growth VIG aims for. It's not a sprint, it's a marathon. A journey towards a prosperous tomorrow. Let's talk numbers. VIG boasts an impressive annual yield. But remember, the true value of VIG isn't just in its yield, but in its potential for long-term growth. It's like planting an apple tree. Sure, it's great to enjoy a few apples in the first year, but imagine the bounty you could enjoy years down the line when that tree matures. That's the kind of vision VIG embodies. Investing in VIG is like placing a bet on a company's future. You're not just investing in their present performance, but in the potential of their continued growth. You're backing their ability to innovate, to adapt, to thrive in a changing market. It's a vote of confidence in their leadership, their strategy, their resilience. But let's be clear, VIG isn't about blind optimism. It's about careful, strategic investment. It's about identifying those companies that have demonstrated a commitment to growing dividends over time, those that have shown they can weather economic storms and come out stronger on the other side. So, if you're looking for an ETF that offers more than just immediate returns, if you're looking for a long-term partner in your financial journey, consider VIG. It's not just about the dividends of today, but the potential dividends of tomorrow. With VIG, you're not just investing in a company's present, but also in its promising future. Moving on, we have the Schwab US Dividend Equity ETF, or SCHD for short. This ETF stands as a testament to the power of dividends in the investment world. SCHD is a compelling choice for investors who are looking for a steady income stream coupled with the potential for capital appreciation. The beauty of SCHD lies in its focus on high dividend-yielding US companies. It's not just about any company, but rather companies that have a consistent track record of paying dividends. This emphasis on consistency allows SCHD to deliver a reliable income stream to its holders. Now let's talk numbers. SCHD boasts an impressive annual yield. Without getting too technical, the yield is essentially the income return on an investment, expressed as a percentage of the investment's cost. The higher the yield, the more income you're getting for your investment. SCHD's yield is a testament to its income-generating prowess. But that's not all. SCHD also offers the potential for capital appreciation. This means that not only could you enjoy a steady income stream from the dividends, but the value of your investment could also grow over time. That's a win-win. But as with any investment, it's crucial to consider the risks. While SCHD's focus on high dividend-yielding companies provides a level of stability, the value of these companies, and hence the value of your investment, can fluctuate, so it's always important to do your homework and assess whether an investment aligns with your financial goals and risk tolerance. In summary, SCHD offers a fantastic balance between steady income and growth potential. It's an ETF that harnesses the power of dividends, providing a reliable income stream while also offering the prospect of capital appreciation. Whether you're a seasoned investor or just starting out, SCHD is a compelling choice to consider in your investment journey. Last but certainly not least, we have the Vanguard Total Stock Market ETF, also known as VTI. VTI is a powerhouse in the world of ETFs, and it's no secret why. This fund offers a wide exposure to the entire US stock market, encompassing everything from the largest blue-chip companies to the smallest up-and-coming startups. With just one investment, you get a piece of the entire American economic pie. It's like taking a cross-country road trip from the bustling streets of Wall Street to the innovative tech hubs of Silicon Valley, all from the comfort of your own portfolio. Now, let's talk about one of the main attractions of VTI, its annual yield. Over the past decade, VTI has consistently delivered an impressive yield, averaging around 2%. This might not seem like a lot at first glance, but in the world of investing, it's a solid return, especially when you consider the potential for capital appreciation in addition to those dividends. But what truly sets VTI apart is its potential for diversified growth. Because it represents the entire US stock market, it's naturally diversified across all sectors. This means your investment is spread out across different industries, reducing the risk of any single sector dragging down your portfolio. Think of it this way: instead of putting all your eggs in one basket, you're spreading them out across several baskets. If one sector experiences a downturn, your investment in other sectors can help offset that loss. This is one of the key principles of investing: diversification. And with VTI, you get that diversification built in. So, if you're looking for a single investment that gives you broad exposure to the US stock market with a consistent annual yield and the potential for diversified growth, VTI is a strong contender to consider. With VTI, you're not just investing in one sector, but the entire US stock market. Now that we've covered VIG, SCHD, and VTI, let's see how they stack up against each other. Firstly, let's talk about their focus. VIG, or the Vanguard Dividend Appreciation ETF, zeroes in on companies that have a track record of increasing their dividends year after year. This focus makes it a compelling choice for those who value steady, predictable income. On the other hand, SCHD, the Schwab US Dividend Equity ETF, aims to provide a high yield, and as a bonus, it also emphasizes companies with a strong financial health. It's an excellent option for those who wish to balance between income and stability. VTI, or the Vanguard Total Stock Market ETF, differs from the previous two. This fund is all about total market exposure. It offers you a slice of the entire US equity market, from the largest companies right down to the smallest. It's a one-stop shop for diversification. Now, let's discuss yield. VG offers a moderate yield, which is suitable for those who are more focused on consistent growth rather than high income. SCHD, however, boasts a higher yield, making it attractive for those looking for a more immediate income stream. VTI, while not specifically a dividend fund, provides a decent yield due to its broad market exposure. As for potential growth, VG's focus on dividend growth companies provides a solid foundation for the future. These are companies that not only pay dividends, but also have the potential to increase these dividends over time. SCHD's yield and financial stability emphasis also offer good growth prospects. VTI, with its broad exposure, has the potential to capture growth across the entire market. But why pick just one when you can have all three? The beauty of these ETFs lies in their differences. By holding all three, you can enjoy the stability of dividend growers, the high yield of strong financial firms, and the broad market exposure of the total stock market. This blend can help you create a well-rounded portfolio that is capable of weathering different market conditions. Remember, the key to successful long-term investing is diversification, and these three ETFs offer just that. So, whether you're a seasoned investor or just starting out, consider adding VIG, SCHD, and VTI to your portfolio. They could very well be the unstoppable dividend growth ETFs you can buy and hold forever. That wraps up our discussion on the top three unstoppable dividend growth ETFs. These financial instruments, namely VIG, SCHD, and VTI, each have their unique features and benefits. They're not just ordinary ETFs. They're designed to provide you with consistent dividend growth, potentially for decades to come. But remember, as with any investment, it's crucial to do your own research before making a decision. It's about understanding your financial goals, risk tolerance, and time horizon. Consider these ETFs as part of your broader investment strategy. They could be the key to unlocking continuous income and achieving your financial objectives. Whether you're new to the investment world or a seasoned investor, these ETFs deserve a spot on your radar, but don't just take our word for it. Dive in, explore, and see for yourself how these ETFs can work in your favor. If you enjoyed the content, don't forget to subscribe, like, and share. Stay tuned for more insightful investment videos.